In precious metals bull markets, gold tends to catch the bid first. People who are worried tend to buy gold first because they understand it better. It's the big brother in the monetary metal space, and they want that full spectrum protection that comes with gold. So they buy it. It goes up more than silver. The gold-silver ratio blows out. It goes up into the 80s or 90s. Eventually, as the precious metals bull market goes on, people start seeing gold as maybe overvalued and silver relatively cheap, and they pile into silver. And silver being a very thinly traded small market, it rockets when people do that. So now the gold to silver ratio is 100. So that is a screaming buy signal for silver historically. If you just bought silver every time the gold silver ratio got up into the 90s, you made a lot of money in silver over time. And now we're at the very high end of silver's typical cycle.
You're watching Capital Cosm. My name is Danny. It is May 8th, 2025. And today's guest is John Rubino. John, thank you so much for coming back on the show, my friend.
Hey, Danny. Thanks for having me back.
Yeah, always a pleasure. Well, let's not waste any time here, John. Let's dive right into the nitty gritty. What's the most pertinent topic for you right now? What do you think should be on the radar screen of investors at this moment in time?
Boy, there is so much going on right now. This is cross currents like I don't remember ever seeing before, because the U.S. is kind of tipping into a recession, which it was always going to do. We were due for a recession after basically growing nonstop since 2009. So that was going to happen, and it was potentially going to be a big one. And we're still kind of creeping in that direction. So that's one story. And then one level up is kind of the revolution that's happening in the U.S. Trump is engineering a break from the past 50 years of globalization and fiat currency and stuff like that, and basically taking us back to mercantilism. So that is a major revolution right there. And it's happening in some ways very cleanly, like they just closed the border down, and that's that. So we didn't need new laws or anything. We just needed somebody who wanted to go there and do it. But lying over that is a lot of chaos, where everything that Trump does gets sent to the courts. And so we have to find out what he can and can't do before we can know what he's going to do, because a lot of things are just going to turn out to be unconstitutional, even after they take it all the way to the Supreme Court. Some other stuff is going to be allowed. So we'll know in about 6 months what Trump is actually going to do, beyond what he's trying to do. And I think he's going to get a lot, So I think that the whole populist revolution thing in the U.S. is real and is going to continue. And now it's spreading to the rest of the world, because you've got the most popular political party in Germany being what they call the center right, which is what in the U.S. we would call moderate Republicans. But and Germany is basically just banning that party. They're going authoritarian. Same thing happened in Romania.
AFD, right?
Yeah, the AFD. Yeah. And now in Britain, they just had local elections, which were a landslide for the what they also call the far right party in Britain. And if you were to nationalize those local elections right now, in other words, same percentage of people vote in a national election for Nigel Farage as voted in the local elections, then you would have Nigel Farage as the Prime Minister of Britain. And that's looking at least conceivable right now, which it never has before, and he's kind of what you would call a populist, where, okay, we're going to close the borders. We're going to deport everybody who's here illegally. We're going to start protecting British culture again, things like that. So, this is happening around the world, and it's very big. Adam Taggart just interviewed the fourth turning guy.
Oh, Neil Howe.
Yeah, Neil Howe. And what what he was saying, he was saying what's going on around the world basically fits very nicely into a fourth turning scenario, which is usually a gigantic crisis where you have some kind of kinetic war, and not just a cultural war, but you have actually shooting and stuff like that. And so that was, interesting and disturbing that what's going on right now fits so well into a long wave framework that ends with a big war. So yeah, fascinating times. And then of course we've got gold, which is now above $3,000 an ounce and holding pretty well. So that kind of implies that the monetary system is being swept up in all of the other stuff that's going on. And we're going to have that currency reset at some point, although we can't know when, we can't know the details of it. But that's something that $3,000 an ounce gold points towards, which is huge for investors. If any of the stuff I just said is something you need to pay attention to when you're thinking about where to put your money, the gold thing is very, very important, because we could easily see a currency reset, and gold is presaging something like that, and that's huge for your investments. So that's the big intellectual challenge right now is, how do we manage our money in a world that's going through a fourth turning and a currency reset at the same time, and of course a populist revolution. Excuse me. And that's not simple, but it's crucial that we think that through.
What do you say to those, especially from like a technical, from a technician standpoint, that say gold has moved on too much too fast, and that it's due for a correction, so to speak, given that it's risen from the doldrums of the $2,000 handle to hitting an all-time high at 3,500 a couple of weeks ago. Now it's back down to 3,300 and some change. Does gold need to spend time and correct a bit because of its move up so rapidly over the last year and a half? Or are the times the times? Are we, simply because of the fact that we are in this fourth turning cycle where the currency is being in the process of being reset, does that not matter? Does technical analysis not matter in this time?
Well, you'd have thought $3,000 an ounce would have been massive resistance for gold, right? Because it basically just broke 2,000 not so long ago, and it blew through the next $1,000 an ounce. Without really any resistance. And now it's up above 3,000. So, it kind of looks like 3,400 for some reason is resistance technically. So there are two ways of looking at your question. One is, technically bull markets do not go on forever in a straight line. They have stomach churning reversals and corrections, and gold is due for that. So we could easily see it just from a technical historical standpoint back down in the mid 2000s, right? We see $2,500 gold again. If it does what it did in, for instance, 2008, recession, equities bear market, gold gets sucked down in that vortex and falls hard. Totally possible. That doesn't change the long-term bull market dynamics in any way. I mean, it's still going up long term because the world's fiat currencies are going down long term. And that's how we measure gold, by these fiat currencies. As they lose value, gold goes up in dollar, euro, yen terms. But there can be corrections along the way. And one in the near term is completely possible, especially since we're headed for that recession with the usual equities bear market, So just the normal economy working itself out would probably send gold down. So now the other possible answer is that the world has changed really dramatically, and we've got several things going on out there that point towards steadily higher gold. One is the BRICS thing. A lot of countries with a lot of natural resources and a lot of people are sick of the US using the dollar as a weapon, and they want to get beyond that. They want to bypass the dollar in their own trade. And they're setting up systems to allow them to do that. And they're accumulating a lot of gold as part of that process. They want to be able to back up their currencies with gold if necessary. And they've been buying without much price sensitivity. It's like they've got a target of ounces or tons. Right. And so they're just gradually building up to that target level. And they don't seem to care very much about the price as they're doing it, because, the local dictator probably told them, we need you to have this many tons of gold. And they're not going to quibble over price because they've been ordered to get to this level. The next part of that is the Basel III change in banking regulation, where gold is now being reset within the banking system from level or a tier 3 asset to a tier 1 asset. And the short version of that explanation is that it makes gold way more useful for banks. So they are buying gold because it's a much better thing to own for them under future regulations than it was in the past. And there's a lot of banks out there, and they don't seem to be all that price sensitive either. They've got to diversify their tier 1 assets now to take into account the fact that there's another tier 1 asset that they need to own. And so they're scrambling to get enough gold to meet the requirements of new regulations. So you take those two things and just let them run, and you've got a tailwind for gold where it would probably rise over time in any event. And it's kind of smoothing out the process so far. It's making it a steady rise instead of an irregular one like most markets when they're on a bull run tend to do. And then, of course, you've got the underlying fiat currencies are dying. We're blowing up the global financial system by spending too much and borrowing too much, and we've got to have a currency reset, which is out there. You take away the Basel III thing and the BRICS thing, we've still got that currency reset out there, which would probably lead to gold some way, somehow being repriced much higher. And put it all together, and there's no way to know what's going to happen in the next 6 months, but you definitely want to own gold as all of these things unfold. And I think that's a reasonable way to approach it. That's what I've been saying on Substack for the last 3 years is, don't jump into this stuff with both feet, but add to your positions with low ball bids and dollar cost averaging and put writing and things like that, especially if you're doing gold mining stocks. And just dollar cost average if you're stacking, buy the same dollar value of gold coins or silver coins each month and just let the piles build up over time, and you'll be fine when all of this plays out the way it's eventually going to. So there's no reason for FOMO now, fear of missing out. But there's absolutely reason for adding to your holdings of precious metals steadily over time. And in 3 years or 5 years or whatever, you're going to be just fine if you do that.
If you're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you. So it sounds to me that you're dealing with central banks and governments that have a need for gold, so much so that they don't really care much for the technical analysis. They don't really care whether the moving average is 50% above its historic average or something like that. They're just telling their people to go get the gold. I don't care how much it costs, just go get it, because we're in a shifting environment.
Yeah, well, that's what it seems like so far. I mean, I don't know which of the explanations that I just gave you is the dominant one. It seems like they're all playing a role in what's happening out there. But having said all that, it also wouldn't be a surprise if China just comes out and does something to smack gold down by $500 an ounce before it steps back in and buys a bunch more. So, because they, if they have a long-term goal, there's no reason why they wouldn't try to manipulate the market to give them a better average price. So, which means dollar cost averaging works in that kind of an environment, but aggressively buying all at once exposes you to a player like China who wants to manipulate the market for its own benefit. So don't do that. Don't just load up on gold because we're talking about $5,000 or $10,000 gold eventually. But do gradually buy it. If people are out there manipulating a market, dollar cost averaging is actually a very beneficial way to play that, because when they manipulate it down, the same number of dollars you're throwing at the market each month buys you more ounces. And when they manipulate the market up, the same dollar amount buys you fewer ounces. So your average price ends up being very favorable. So I definitely think, that's been the way to do it all along. It remains the way to do it no matter what's happening out there.
Very interesting. You want to talk about manipulated markets? Look at silver. Silver sitting at $33, $32 now. What do we make of the price of silver? Silver has been lagging behind its big brother, gold there. Why is that? Why do you think silver hasn't made any new all-time highs past the $50 point like gold has, with, smashing through 2,100 all the way up to 3,500?
Well, with silver, there are always these allegations or speculation about manipulation, and I wouldn't put it past the big banks to manipulate the price of silver so that their big industrial customers are able to buy it more cheaply. That's a totally conceivable scenario. But silver has some other stuff going on too. It's an industrial metal as well as being a monetary metal. And if we're headed for a recession, then that might diminish the demand for silver. It might lead to people selling it or just not buying as much, and it might make the price go down a bit, and maybe people are cautious in the short run because they see that coming. That's a possibility. And another thing about silver right now, which actually kind of fits history, is that in precious metals bull markets, gold tends to catch the bid first. People who are worried tend to buy gold first because they understand it better. It's the big brother in the monetary metal space, and they want that full spectrum protection that comes with gold. So they buy it. It goes up more than silver. The gold-silver ratio blows out. It goes up into the 80s or 90s. Eventually, as the precious metals bull market goes on, people start seeing gold as maybe overvalued and silver relatively cheap, and they pile into silver. And silver being a very thinly traded small market, it rockets when people do that. So now the gold to silver ratio is 100. So that is a screaming buy signal for silver historically. If you just bought silver every time the gold silver ratio got up into the 90s, you made a lot of money in silver over time. And now we're at the very high end of silver's typical cycle relationship to gold. So history is saying that now is a very good time to buy silver relative to gold. If you were a very aggressive trader and you were looking at history, you could short gold and buy silver. Don't do that, though. But this would be a time where if you are trying to decide which to buy more of, silver and gold, you could look at that 100 gold to silver ratio and choose to buy silver, and you would probably be right based on history. So I think the silver story, okay, and meanwhile, the industrial metals story with silver is positive, even though short term, cyclical, there are risks. Silver, mostly based on industrial demand, is in deficit right now. In other words, the world's mines aren't producing enough silver to satisfy the solar panel makers and the missile makers and the electric car makers out there who need silver for their products. So over time, as the market stays in deficit, we're using up the available above ground stocks of silver, making the market even tighter, and increasing the odds of some kind of a short squeeze at some point where silver just goes straight up and the commodities exchanges have to default and give you cash instead of silver when you try to take delivery on a futures contract or something like that, which terrifies people and sends silver up even more. So you got that scenario out there that's very possible. And the industrial metal side of silver's story is a big driver of that, because right now that's why we're using up so much above ground silver. So yeah, silver's a great story. And the near term is a little bit risky, but the longer term is basically as good as anything you could ever hope for in the commodities space. So, I own a relative large amount of silver compared to gold because of that. And that means I haven't made as much money as I would have if I'd just gone, 50-50 gold and silver in terms of dollar investment or whatever. But I am still pretty confident that choice, the difference between the gold and silver that I own will pay off in the end. And I think that that's a reasonable way to approach the market now. In your dollar cost averaging, lean a little towards silver versus gold right now.
Right. So I have a visual that we can look at. So you've got gold here in the chart above, and on on the chart below here in white, you've got the silver price. So you got gold versus silver. And I want to take us through various time intervals and see how silver has performed relative to gold to kind of see, to kind of visualize what you've just spoken about here, John. From a 5-day view, so from a weekly view, I mean, this is how it looks. The movements seem to track each other, but nonetheless, silver has underperformed gold. From a monthly view, again, the movements correlate with one another, but you still see an underperformance of silver there in white. From a 3-month view, silver is vastly underperforming gold, namely because of the crash here on April 25th. I believe that was Liberation Day. No, that wasn't Liberation Day. That was something else. So we saw a pretty steep correction here on the 25th for both precious metals, but more so on the silver side. 6-month view, boom, the gap is getting even wider between the two. Year-to-date view, which is pretty much the same thing. Again, same gap. 1-year view, 5-year view, and then here's the kicker. If you stretch this thing all the way back to 1833, you can clearly see the gap that's been formed between the two metals. And I'm of the mind that eventually, maybe not the entirety of this gap, but a significant chunk of this gap has to mean revert, so to speak. So since 1833 to present day, silver's gone up 2,400%, gold has gone up 15,000%. So
interesting, yeah. And see, if you run those charts in reverse order now, from distant to recent,
right,
silver starts to perform a little bit better. So that would imply that so as this precious metals bull market starts to it progresses, then more and more people are looking at silver as an alternative. And historically, silver outperforms gold in percentage terms really dramatically for the last couple of years. So you would expect that chart, if history repeats, you would expect that chart to look more and more favorable for silver as it breaks through the gold line and just takes off and goes parabolic.
You can see it. You can see it. The more I zoom in, the more I zoom into present day, the tighter the gap gets. So if you keep it at, if you use 1833 as a starting point, but then you zoom it in, you can see that gap start to close more and more as we get closer to today.
Yeah, so, see, that's encouraging for silver. Yeah. And maybe 6 months from now, we come back and run these charts again, and silver is above gold on the chart. And I mean, that's totally possible.
Right. So you mentioned the miners. Why haven't, so we've seen a moving gold price to the positive side, but then you look at oil. Oil's been, let me turn off the silver chart here. Oil's been in a bear market. I mean, it's broken down beyond the support line here, but the gold prices become elevated. Why haven't these mining companies seen their margins improve? If your input costs, i.e., oil, is going down, but your revenue, your potential revenue from sales and gold is going up, why haven't they kept pace?
Well, see, everybody expected the miners to outperform gold and to an extent silver, although there's so few primary silver miners that it's really hard to talk about them in general terms. But with gold, normally the miners are more volatile in both directions. In other words, when gold goes up, the miners go up more. When gold goes down, the miners go down more. But this time around, gold went up, but it didn't instantly translate into wider margins for the miners because their costs were going up so dramatically. And that was oil and labor and, to an extent, taxes in some countries. And so the miners, even though gold was up, were reporting kind of disappointing earnings, and nobody was excited about them because, there was Bitcoin out there and Nvidia to be excited about. So the miners languished. But lately, just in the last 2 quarters, miners have started putting up really good numbers because gold has gone up enough to more than offset cost increases. At the same time, those cost increases have been going, or slowing at least, because like you said, oil, which is a big part of the cost equation for a miner, has been going down lately. So now you're seeing the miners report really nice quarterly numbers where their revenue goes up because what they're selling has gotten a lot more valuable. And that translates into higher earnings and dramatically higher cash flow. So now these are looking like very healthy growth stocks, the miners. And with that free cash, they can improve themselves. They can pay off debt. They can raise their dividends. They can buy back stocks. They can go out and make accretive acquisitions because the junior miners are still relatively cheap in this space. So the big guys are looking very good financially and improving because they're using their free cash flow to make themselves more valuable. So now you've got Agnico Eagle and GDX and Newmont and names like that in the big miner space performing really well. And what that leads to is generalist money coming into the sector because the big guys, the big names are doing well. And then that generalist money normally flows downward through the food chain until it hits the exploration companies and starts bidding them up. And then you get a full-fledged mining stock bull market. So if gold stays above $300 or $3,000 an ounce, that's what we should expect in the year ahead. The miners put up great numbers. That gets people excited. Money pours in. We get the M&A mania probably, where the big guys buy out the little guys at ever larger premiums, and we get, in other words, a normal mining bull market in the precious metal space. That could be a second half of 2025 story, and if not, it's probably a 2026 story as long as gold holds up. This is all premised on $3,000 an ounce gold.
What's fascinating here is that I've got GDX here in white, and then in yellow, I've got the gold to silver ratio, and there appears to be an inverse relationship between the two. So when one goes up, the other goes down, which makes sense, right? Because you're mining, when silver begins to outperform gold, that's your sign that you're in a maturing precious metals market. Otherwise, you're still at the very beginnings of it. And if that is the case, then the miner should begin getting a bid. And that's what you see here in this chart. When the ratio goes down, GDX goes up and vice versa.
That's a really useful chart, Danny. Nice. Yeah, because it does show an early stage precious metals bull market where gold is up more than silver, and the gold miners are starting to respond to that, but silver has not yet. And so normally, precious metals bull markets go for a few more years after this.
Mm-hmm.
So based on this chart, we got 2 or 3 really good years ahead of us, and I
Yeah.
think
So
that's
in yellow, you've got the gold to silver ratio, and this chart goes all the way back to the 1930s, and you can see here. I mean, I think you mentioned this before, but we've only been at this level once before, and that was what, the 2020 COVID scare was, when everything was all screwed up. But aside from that, the gold to silver ratio has never been at this level before, stretching back for close to 100 years now.
yeah. History isn't always a perfect predictor of the future, but if you look at just history, this seems like a really good time to be buying silver, or at least buying it relative to buying gold. So if past is prologue, the silver stackers are going to have a really nice few years ahead of them.
Yeah, yeah. So what else? I mean, what else do you see going on out there? I mean, we've pretty much covered. I think we've covered pretty much everything there is to cover on the gold side of things. On the economic side, we have this new trade deal done with the UK, on the part of Trump. He just announced it today. Are there any details that you've been able to extract from it in terms of what it means moving forward?
Well, I just saw a headline with the first few lines of a story on this, and it looks like the US and the UK are going to have reciprocal 10% tariffs, and that's it. Otherwise, free trade. So, it's funny. The Trump strategy of raising tariffs on everybody seems like it's an anti-free trade strategy, right? But the end goal of the negotiations might be a very simple, very mostly free trade kind of regime out there where the tariffs that do exist are very clear, very understandable, and there aren't any other trade barriers out there. And if that's the case, that's okay. That's a simple, easy to understand international trading regime. And to the extent that the tariff thing has added an element of chaos to what's going on in the US and around the world, if the UK deal is a sign of things to come, which I think it might be because it's the simplest way to get out of this current issue, then from the standpoint of simplicity and understandability, that's a good thing. It means the world trading system will go back to being something that companies deciding whether or not to set up factories will be able to understand and project into the future to give them a sense of what the world is going to be like, and therefore to be more likely to build that factory. Capitalism needs certainty, at least in some things. It needs to know that the currency is going to have some value going forward, so you can project your sales onto your profit statement. And they need to know, that political stability is going to be more likely than not. And without that, nobody wants to commit capital and factories don't get built. But if you have it, if you have the rule of law and you have simple, understandable regulations and stable monetary policy, then capitalism goes into high gear. People set up factories all over the world and we get richer. So if that's the end result of Trump's strategy, then that would be a really good thing. And the UK thing is, maybe a sign of things to come. By the way, in the case of the UK, they're descending into political chaos. So it's possible that they signed a deal they might not have signed otherwise because they need to stabilize themselves. And globally, trading with the US is one big aspect of stability for the UK. And maybe they took this deal because the most recent elections look like they're headed for some kind of a revolution or civil war or something like that. And they want to stabilize what they can going forward.
Is that also why Europe seems to now be open to dealing with China from a trade perspective? I don't know if you've been watching this, but there has been talk of greater relations between the EU and China moving forward, which is very interesting given China's relationship with Russia and Europe's relationship with Russia. What's your take on that?
Well, Europe has interpreted Trump's first 100 days as a slap in the face. You know, they viewed the U.S. and NATO and the other NATO countries as global allies, geopolitical allies who would work together. And Trump came in and said, listen, you know, you guys are committing cultural suicide. You're going authoritarian, your borders are wide open. You're more excited about this proxy war in Ukraine than you should be. And you need to get your house in order for us to continue to pay the lion's share of NATO's expenses. And, so Europe in this situation is kind of like the 33-year-old child who's living in his parents' house, and they tell him he has to go get a job, and he's shocked and betrayed by them wanting him to stand on his own 2 feet. That's kind of what the U.S. did with Europe, at least geopolitically. And so it's not a surprise that they're looking around for other allies because they feel like they've been cut loose and they're all alone in the world. And, I'm not sure China would be the ideal ally for Europe, but we'll see, and I think at the same time they're doing that, they're probably looking at the UK deal and what's on the table from the US and thinking, well, okay, maybe we cut these trade deals that lower tariffs dramatically and get rid of the rest of the restrictions. And maybe we go back then to being strong allies with the US, but who knows? Like I said, there are things that are happening that are very good and very clear. And then there's this layer of chaos on top of everything else that's going on in the world. And there's really no way to know exactly how all of this stuff plays out, or even what the motivation for a lot of things are. I mean, I think you can interpret what Trump's doing one way and maybe be right. He wants to change the behavior of our trading partners in ways that lead to them simplifying their trading rules, lowering the barriers to U.S. exports to them, and setting up a lot of their factories in the U.S. so that we reindustrialize. And if that's what he wants, then I'm all for it.
And he also doesn't have much time. And this is, something I've come to realize. At first, it may appear to have been shock and awe, and it was, quite frankly. But when you take into account the political nature of, the nature of U.S. politics, and how you have like these midterms coming up in a year and a half now, really, this was really the only way to bring everyone to the table this fast. Going around, setting up appointments with each individual country. There would not have been the same sense of urgency on both parties to get stuff done as there is now. By kind of like throwing this, Liberation Day monkey wrench into the system, now you have the world incentivized to come and make a deal. And time is of the essence because, again, you have midterms coming up in a year and a half. Campaigns for the midterms begin in a year's time. So you're really going to be tied up in campaigning. You can't really afford to drag this thing out much longer, especially if you have a Democratic Congress coming up in a couple of years that will, stop you from doing your tariff deals and things like that. So I think that's a key point to take into account.
Yeah, the populist revolution in the U.S. has a year and a half. And then if they don't get a lot of their stuff done now, it's completely possible we have a divided government that's completely hamstrung in 2028. Or wait, it'll be 2027, right? Yeah, after the 2026 election. Yeah, so 2027, then everything just grinds to a halt.
Unless he just knocks it out of the park. Yeah, unless he just knocks it out of the park the next year or so. And
that's what they have to do.
Yeah, he's able to maintain his majority Congress. But history will tell us that that's very unlikely.
Yeah. Normally, the party in power loses Congress in the midterm elections. It's just how it normally works. So those guys, they know they've got their 2 years. They don't know what they have beyond that. So you're right. There's a real sense of urgency. So this feels almost, it feels like a revolution. It feels like things just being overthrown all at once. And it kind of is, because it has to be for us to transition from globalization and fiat currency, yada, yada, to mercantilism and populism. And that's what Trump wants to do. And that's what's evolving all around the world. I mean, every election brings just about every country further into that, in that direction. So, yeah, and it has to happen pretty quickly if it's going to happen. So, these are fascinating times. And I think that this is kind of equivalent to the election of FDR and the stock market crash and the beginning of World War II and everything, Great Depression. We're in a time like that, where old systems are being overthrown, and we don't exactly know what the new ones are going to look like. But in the US, at least, the guy who's in charge seems to have a pretty good idea of what he wants. So we'll see. But there's no way to know ahead of time where we end up 2 years from now. But
yeah, for better or
we
for
understand.
worse, I mean, no one's had the courage to do what he's done, for better or for worse. So you've got to give him that. John, thank you so much for coming on, my friend. I think we've covered pretty much everything I had in store. Anything else you want to talk about before we wrap up here?
Thanks, Danny. Now there's so much. Let's just reconvene in a few months, and we'll pick up where we left off.
All right, sounds good. Go ahead and plug your Substack and your socials there, John.
Yeah, I'm at rubino.substack.com, and I publish a newsletter there that covers actionable advice for most of what we talked about today.
Awesome. We'll have to link that down below, so be sure to check it out, guys. If you enjoyed this podcast, drop us a like and comment. Go, John, go in the comment section. Subscribe to the channel so you don't miss an episode. And let me know your thoughts. Even if you disagree, that's perfectly fine too. But let me know what you disagreed on. And I do read the comments. So also check me out on Substack. It's capitalcosm.substack.com, where you can get early access, ad-free versions, and uncensored versions of all of my interviews that you won't, for the ones that warrant it. And then finally, check out our list of sponsors in the description box. We've got tons of discounts, exclusive discounts for you guys with some of these sponsors and affiliates. So great newsletters like Capitalist Exploits, the Trends Journal, Rebel Capitalist Pro with George Gammon. So lots of good stuff down there in the description box. So do a little shopping, see if you find something that you like. I'd really appreciate it. If you supporting my sponsors also supports the channel. So thank you so much for watching, guys, and I'll catch you in the next episode. Bye, y'all.